Picture this. You're standing outside a McDonald's on a busy Friday evening. The drive-through line is wrapped around the building. The lobby is packed. The registers haven't stopped ringing for hours. Every 60 seconds, another transaction. Another $5. Another 10. Another 25 for a family meal. You think to yourself, whoever owns this place must be printing money. And on the surface, that thought makes complete sense. McDonald's is the largest restaurant chain on the planet. It serves approximately 70 million customers every single day across more than 45,000 locations in over 100 countries. The brand is so powerful, so deeply embedded into daily life, that economists actually use the price of a McDonald's Big Mac to compare the cost of living between different countries. That's how universal this thing is. And yet, here's the contradiction that almost nobody talks about. The people who actually own these restaurants, the franchisees who put up millions of dollars and run these locations day to day, many of them are working extremely hard for profit, margins that would genuinely surprise you. Some are doing very well. Others are barely keeping their heads above water. A handful are losing money altogether. So how does a business that sells billions of dollars of food every year still leave its own operators squeezed? The answer lies in one of the most brilliantly engineered business models in corporate history, a model that isn't really about selling burgers at all. Today we're going to discover how owning a McDonald's franchise really works, what it costs to get in, where the money comes from, where it goes, what the real profit looks like, and whether buying one of those golden arches is actually a smart investment or one of the most expensive lessons in business you could ever learn. Most people look at a McDonald's and see a restaurant. Ray Kroc, the man who turned McDonald's into a global empire starting in the 1950s, looked at it and saw something completely different. He saw real estate. He saw a system. He saw a machine that could be replicated, standardized, and deployed in every city on Earth. That vision shaped everything. And it's exactly why understanding the economics of a McDonald's franchise requires a mindset shift from the very beginning. Today, more than 95% of McDonald's restaurants worldwide are not owned by the McDonald's Corporation. They're owned by individual franchisees, independent business operators who paid to be licensed the brand, the systems, and the recipes, and who now run the day-to-day operation themselves. Here's what we're going to cover. How a McDonald's franchise actually makes money, what it costs to open one, where your operating expenses go every month, the hidden costs that new owners almost never anticipate, how the most successful operators build real wealth, a real-world case study of the model at work, and a look at where this business is heading in the years ahead. By the end of this, you'll understand something that very few people outside the industry actually grasp, that buying a McDonald's franchise isn't really buying a restaurant. It's buying a position inside one of the most sophisticated economic systems ever constructed. And whether that works in your favor depends entirely on understanding the rules of the machine before you climb inside it. Part 1. How the business makes money. The obvious answer is you sell food. Burgers, fries, chicken sandwiches, McFlurries. People pay money. You hand them a bag. Repeat 10,000 times a week. But the economics run deeper than that. The primary revenue source for any McDonald's franchisee is indeed food and beverage sales. A typical U.S. McDonald's location generates somewhere between $3 and $4 million in annual revenue, with the median sitting at around $3.8 million. Based on recent franchise disclosure data, high-traffic locations in dense urban areas or near major highways can push well above that figure. Revenue comes in through several channels: the counter, the drive-thru, the mobile app, and increasingly, third-party delivery platforms. McDonald's has invested heavily in its own loyalty app, and digital ordering now accounts for a growing share of sales at most locations. This matters economically, because digital customers tend to spend more per visit than walk-in customers, and the data those transactions generate helps operators manage their inventory and staffing more precisely. There's also a secondary revenue dimension that most franchisees think about: eventually scale. A single restaurant generates a certain income. 2 restaurants managed well with shared overhead generate considerably more per dollar invested. 3, 4, 5, the economics change meaningfully as you build what McDonald's officially calls a portfolio of locations. The company actively encourages and in many cases prefers experienced operators taking on additional locations, because a skilled multi-unit operator is a more reliable partner than a nervous first-time owner. But here's the structural reality that shapes everything else. McDonald's Corporation collects fees from your revenue before you pay a single other bill, the royalty fee, the advertising contribution, and rent, all taken as a percentage of your gross sales. Every dollar you bring in, McDonald's takes its share off the top. That share is significant, and understanding it is the key to understanding everything that follows. Part 2, Startup Costs. This is where most people's enthusiasm meets its first real test. Opening a McDonald's franchise is not cheap, not even close. According to the most recent franchise disclosure document, the official legal document, McDonald's must provide to every prospective franchisee. The total initial investment for a traditional U.S. restaurant ranges from approximately $1.5 million to $2.7 million. The franchise fee itself is $45,000. That's the entry price just to license the name and the system. But that fee is the smallest line item on the list. The bulk of the startup cost goes toward the physical, restaurant and the kitchen equipment, the fryers, the refrigeration systems, the drive-through technology, the seating, the signage, and the digital ordering infrastructure. This category alone typically runs between $1.1 million and $1.8 million, depending on the size and format of the location. On top of that, you'll need opening inventory, an initial stock of food, packaging, and supplies, which adds another $20,000 to $40,000. Miscellaneous opening expenses, including business licenses, insurance, uniforms, cleaning equipment, and pre-opening labor costs for training your crew, add another $50,000 to $65,000. And before your doors even open, you'll need 3 months of working capital sitting in reserve and between $250,000 and $440,000 to cover payroll, supplies, and unexpected expenses while the restaurant ramps up. And here's something that surprises almost every first-time candidate. Before McDonald's will even consider your application, you must demonstrate that you have at least $750,000 in liquid, non-borrowed assets, not total net worth, liquid assets, cash or near cash. This single requirement screens out the overwhelming majority of people who think they want to own a McDonald's. There's also the training commitment to factor in. McDonald's requires every new franchisee to complete between 12 and 18 months of hands-on training before they're approved to open. This includes time at what McDonald's calls Hamburger University, its internal training program. You won't be sitting in a classroom. You'll be working in actual restaurants, learning every station, every process, every operational standard from the inside out. During this period, you're not earning revenue. You're investing your time along with your money. Part 3, Operating Expenses. Once your restaurant is open, the math becomes a constant balancing act. Your 2 largest operating expenses by a significant margin are food and labor. Food costs, everything that goes into making and packaging what you sell, typically run around 30% of revenue. On a restaurant doing $3.8 million in annual sales, that's roughly $1.1 million in food costs alone every single year. Labor is the second heavyweight. Wages, payroll taxes, benefits, and the cost of managing constant employee turnover typically consume another 25 to 30% of revenue. As minimum wages have risen across the United States in recent years, this number has grown, and it's one of the reasons franchisee profit margins have been under pressure even as total sales figures have climbed. After food and labor, you're paying rent to McDonald's. This is a critical structural point. Unlike most franchise relationships, McDonald's typically owns or controls the real estate and then leases it back to the franchisee. This rent is usually calculated as a percentage of gross sales, often in the range of 10 to 12% rather than a flat monthly number. That means as your restaurant performs better and revenue climbs, your rent payment grows along with it. Then come the royalty and advertising fees. McDonald's charges a royalty of 4 to 5% of gross sales, plus a mandatory 4% contribution to the National Advertising Fund. Combined, that's 8 to 9% of your total revenue, going back to McDonald's Corporation every single month, without exception. When you add rent, royalties, and advertising together, you're looking at a combined obligation to McDonald's of roughly 18 to 22% of gross sales before you've paid for a single burger, employed a single worker, or kept the lights on for a single day. The remaining expenses, utilities, insurance, maintenance, POS technology fees, accounting, cleaning, and small equipment replacement, collectively add another 6 to 8%. When you total everything up, the operating costs of a well-run McDonald's franchise consume roughly 85 to 90% of revenue, leaving a net profit margin in the range of 10 to 15% for a well-managed location. Part 4, the hidden costs. Here's where the real story gets interesting, and where new franchisees tend to get their most expensive education. The first hidden cost is equipment failure and mandatory upgrades. McDonald's periodically requires franchisees to remodel their restaurants or upgrade equipment to meet new brand standards. These renovation cycles can cost hundreds of thousands of dollars, are non-negotiable, and often arrive while you're still paying off the initial investment from your opening. The second is technology fees. McDonald's has invested aggressively in digital ordering kiosks, mobile app integration, loyalty systems, and drive-through AI technology. These systems require ongoing software licenses, hardware maintenance, and periodic upgrades, all of which fall on the franchisee. They're necessary investments, and they do improve sales over time, but they represent a recurring cost that didn't exist in the franchise model a decade ago. The third hidden cost is employee turnover. The fast food industry has one of the highest employee turnover rates of any sector. Every time a crew member leaves, the restaurant absorbs the cost of recruiting, onboarding, and training a replacement. And during that learning curve, service slows, waste increases, and quality can suffer. In tight labor markets, the cost of simply keeping enough staff on the schedule can become a genuine operational crisis. Fourth, and this catches almost every new owner off guard, is the cost of compliance. McDonald's has exhaustive operational standards covering food safety, cleanliness, service speed, product quality, and customer experience. Regular inspections can result in required corrective actions, which translate into additional costs and time. Failing to meet standards repeatedly puts your franchise agreement at risk. And fifth, the litigation risk that comes with employing a large workforce in a regulated industry. Wage disputes, workplace injury claims, and employment law. Compliance are ongoing concerns for any multi-employee operation, and legal costs can appear suddenly and without warning. Part 5. How successful owners actually make money. Given everything we've just covered, how do the operators who genuinely thrive in this system actually do it? The first answer is scale. A single McDonald's, operated at the median performance level, generates an estimated annual owner income of somewhere between $460,000 and $575,000 before debt service. That's meaningful money. But the operators who build genuine wealth almost always do it across multiple locations. 3 restaurants with shared management overhead, a shared accounting function, and an experienced general manager overseeing operations don't cost 3 times as much to run as one restaurant. The fixed costs spread, the income multiplies, and the economics compound. The second answer is operational obsession. The difference between a McDonald's generating 13% net margin and one generating 8% margin often comes down to food waste, scheduling efficiency, and customer throughput speed. The best operators track every metric, manage labor costs in real time, minimize food spoilage, and run their drive-through with a precision that shaves seconds off average service times. When in a restaurant doing thousands of transactions per week, seconds translate directly to dollars. The third answer is the 20-year franchise term. A McDonald's franchise agreement runs for 20 years. For an operator who builds strong unit economics over that period, the franchise itself becomes an asset that can be sold, often at a significant multiple of annual earnings. McDonald's franchise agreements are transferable, subject to corporate approval, and the most successful ones have genuine resale value that represents a second major wealth-building event beyond the annual income the restaurant generates. A Part 6 and real case study. To understand what this model looks like in practice at scale, consider the story of what happened system-wide in 2024. McDonald's faced one of its most challenging years in recent memory. An E. coli outbreak linked to contaminated onions hit headlines nationwide, temporarily shaking consumer confidence. At the same time, rising menu prices had begun to push lower-income customers away, causing traffic declines at a moment when the industry was already dealing with elevated labor costs. The corporate response was instructive. McDonald's launched a $5 meal deal, leaned heavily into value messaging, and accelerated its digital loyalty program to drive repeat visits. By the end of 2024, the company reported system-wide sales recovery, and by 2025, U.S. average unit volume had climbed to $4,057,000 through this highest in the burger quick service restaurant category. By the first quarter of 2026, system-wide sales were up 11% year over year. The lesson for franchisees wasn't just that McDonald's recovers from adversity. It's that when McDonald's corporate invests in national marketing, value campaigns, and brand rebuilding, individual franchisees benefit directly. The National Advertising Fund, that mandatory 4% of sales that every franchisee contributes, bankrolled the recovery campaign that brought customers back to their specific restaurants. This is the part of the franchise model that gets lost in conversations about fees. Those fees don't just go to McDonald's. They come back in the form of advertising power that no independent restaurant could afford on its own. Part 7, the future of the business. The McDonald's of the next decade will look meaningfully different from the one most of us grew up with. Artificial intelligence is already being tested in drive-through ordering systems, with AI handling customer conversations and menu suggestions before a human ever gets involved. Self-ordering kiosks have become standard in most locations, reducing front-counter labor requirements. AI-powered demand forecasting is helping operators predict how many units of each menu item to prepare at each hour of the day, reducing food waste and improving margins. Delivery has gone from a novelty to a significant revenue channel, but it comes with its own economics. Third-party delivery platforms typically charge restaurants a commission of 15 to 30% of the order value, which dramatically reduces the profitability of delivery sales compared to in-restaurant sales. The most sophisticated operators are actively managing their delivery mix, pushing customers toward the McDonald's own app where commissions don't apply, rather than relying on platforms that take a major cut of every order. The biggest structural trend, however, is the continued expansion of digital loyalty. McDonald's loyalty program has enrolled tens of millions of members globally. Members visit more frequently, spend more per visit, and generate valuable behavioral data that McDonald's uses to optimize everything from marketing to menu development. Franchisees who engage their customers through the digital ecosystem perform better than those who don't, and this gap will likely widen in the years ahead. So is owning a McDonald's franchise worth it? The honest answer is it depends entirely on who you are, how much capital you have, and how clearly you understand the numbers before you sign anything. The brand is real. The customer traffic is real. The support systems are real. The 20-year term creates a genuine long-term asset. And for operators who build multi-unit portfolios and run them with operational discipline, the wealth-building potential is significant. But the investment is enormous. The fee structure is demanding. The operational requirements are relentless. And the profit margins, while real, are considerably thinner than the drive-through line on a Friday evening might lead you to believe. The single most important takeaway from everything we've covered today is the one that applies to every business we'll ever examine on this channel. Revenue is not profit. A restaurant doing $4 million in annual sales is not a business generating $4 million in income. It's a business managing $4 million in cash flow, from which labor, food, rent, royalties, technology, equipment, insurance, and 100 other costs must be subtracted before the owner keeps a single dollar. The entrepreneurs who succeed inside this system are not the ones who were most excited about McDonald's when they applied. They're the ones who ran the complete numbers, understood every obligation before committing, built their operation with genuine management discipline, and treated it from day one as the business it actually is, not the easy money it looks like from the outside. That's the economics of owning a McDonald's franchise. If you found this video useful, subscribe for more videos about business, finance, investing, economics, and wealth building. There's a lot more to explore, and every business, no matter how familiar it looks from the outside, has a completely different story on the inside.